All right, let's jump right into this explainer and unlock the secret language of financial statements. Today, we're putting on our detective hats to decipher a genuinely crucial piece of the financial puzzle, Accounting Standard 1, or just AS1. If you've ever looked at a company's financial report and felt like, I don't know, you were only getting half the story, well, you were probably right. And today, we're going to learn exactly where to find the other half. Now, before we get too deep in the weeds, let's clear up a pretty massive misconception. You might think accounting is just rigid math, right? A world where 1 plus 1 always equals 2, and where every single transaction fits perfectly into a neat little predetermined box. Well, I'm going to challenge that assumption right now. Let me ask you, is accounting an exact science or is it an art? The reality is, it's actually both. It's a science because, yes, we have the universally tested principles, but it's absolutely an art because applying those principles depends heavily on the personal judgment of the accountant. Because of that human element, two different companies can take the exact same underlying transaction and report entirely different financial results. Crazy, right? So to make sense of all this, here is our roadmap for today. We'll be covering why accounting isn't exact, fundamental assumptions, choosing policies, the rules of change, and finally, decoding the fine print. Let's start with Section 1, why accounting isn't exact. Picture this, two completely identical companies in the exact same industry. They buy the exact same goods at the exact same prices. But Company A uses the first in, first out, or FIFO method for valuing its inventory. Meanwhile, Company B uses the weighted average method. Both of these are perfectly legal and acceptable under accounting standards, yet at the end of the year, their reported profits and inventory values are going to look completely different. If you, as an investor, don't know which method they used, how can you possibly compare them fairly? So you might be wondering, why even allow this diversity? Well, think about it. A little corner fruit cart operates in a vastly different, way less complex reality than a massive global tech giant, right? It's fundamentally impossible to develop a single, one-size-fits-all set of policies for every unique business out there. And that is exactly where Accounting Standard 1 steps in. It has a super simple mandate. Companies must clearly disclose the specific accounting policies they've chosen to use. It's all about keeping things transparent. Moving right along to Section 2, Fundamental Accounting Assumptions. Now, these are the fundamental assumptions, basically the holy trinity of accounting: going concern, consistency, and accrual. Going concern just assumes the business will keep operating indefinitely, without having to drastically shut things down. Consistency means you're using the same accounting policies from one year to the next. And accrual means recognizing transactions when they actually occur, not just when the cash physically changes hands. This just gives a much more accurate picture of revenues and costs. Now, here's where your detective work comes in. The golden rule for these three assumptions is beautifully simple. Silence means compliance. If a company follows these default settings, they don't even need to mention it. We just assume they are. But if they break them, say they're facing bankruptcy and are no longer a going concern, or they randomly shift to a cash basis, they absolutely must explicitly disclose that fact in the financial statements. Let's dive into Section 3, choosing the right policies. When companies actually sit down to pick their customizable policies, they lean on three major considerations. Number one is prudence. In the unpredictable world of business, it's always better to be safe than sorry. This is a highly conservative approach. It basically says, never count your chickens before they hatch, meaning don't anticipate future profits, but you absolutely must provide for all known liabilities and losses, even if you're just making your best estimate. It keeps companies from artificially pumping up their assets or hiding their debts. To really see this in action, imagine a trader valuing some unsold stock. Say they bought goods for 10 rupees. In scenario A, the market value jumps up to 15 rupees. Does the trader pop champagne and record a 5 rupee profit? Nope. Prudence says you value it at the lower cost of 10 rupees and just ignore that unearned profit. But in scenario B, the market value drops to 8 rupees. Here, prudence forces the trader to immediately value the stock at 8 rupees, taking a 2 rupee loss right then and there, even before they've sold the item. The second big consideration is substance over form. Now, this sounds a bit philosophical, but it is deeply practical. It ensures that the true economic reality of a transaction is what actually gets recorded, rather than letting clever legal paperwork mask what's really going on. Like, if a lease is functionally the exact same thing as buying an asset outright, you record it as an asset. Doesn't matter what the legal lease document calls it. And the third one is materiality. Think of materiality as a crucial filter.
You obviously don't need to disclose every single paperclip the company buys, but you must disclose information that might actually influence an investor's economic decisions. And listen, it's not always about massive numbers. Even a really small amount of money lost to, say, employee fraud is material. Why? Because it points to a serious flaw in the company's internal controls, and investors definitely need to know about that.
All right, Section 4, the rules of change. Look, a company can't just flip-flop its policies from year to year to artificially manipulate its profits. Consistency is key. Changing policies is strictly regulated and is only allowed under 3 very specific conditions. 1, if a new law or statute requires it. 2, if a newly issued accounting standard demands it. Or 3, if management can actually prove that the new policy will result in a more appropriate presentation of the financials. That's it.
And when a change does happen, it triggers this strict disclosure logic tree. It's all about total transparency. If the change has a material impact right now and you know the amount, you have to tell users the exact specific amount affected. If it impacts things right now but it's just too complex to calculate, you have to formally admit that the amount is unascertainable. And honestly, even if the change doesn't affect this year's numbers but will impact future years, you still have to disclose the fact that you made the change today.
Let's put a number on it to make it concrete. Say 20,000 rupees. Imagine a company shifts its inventory valuation from FIFO to the weighted average method we talked about earlier. Doing that pulls down their calculated profit by exactly 20,000 rupees. Under AS1, there's no hiding that drop. They must write a specific note explicitly stating that this policy change reduced their profits by 20,000 rupees. Again, transparency is totally non-negotiable. Wrapping things up with Section 5, decoding the fine print. Here's the good news. IS1 makes life a little bit easier for us financial detectives. It requires that all these massive accounting policy choices shouldn't just be scattered randomly throughout a 100-page document. They should normally be grouped together and disclosed in one single accessible location. Usually, you'll find this right up front as Note 1 or in a dedicated significant accounting policy section. This should literally be the very first place you look. So why does all of this matter so much? Because the real-world stakes are huge. In one scenario, we see a company facing a 10 crore deficit decides to just change how they value inventory. They shift from prime cost to works cost. By doing nothing but changing that definition, they magically inflate their inventory value and turn a 10 crore deficit into a reported profit. In another case, a company struggling for cash tries to avoid recording overdue interest on deposits. But AS1 says, nope, failing to record that violates the fundamental assumption of accrual. You can't just ignore a liability because it's inconvenient. And that brings us to our ultimate takeaway. The numbers you see on an income statement, they're really just the tip of the iceberg. The accounting policies are the massive hidden structure beneath the water that actually dictates what those numbers mean. So I'll leave you with this. Next time you pick up a financial report, are you just going to stop at the headline profit margin, or will you put on your detective hat and investigate the vital policies shaping it? Thanks for joining me on this explainer. Keep questioning everything you read, and I'll catch you next time.